Hello and welcome to another Energy Connect discussion. Our conversation today is taking place after the OPEC meeting, which was on Sunday evening, where the organization announced that it will be extending its production cuts until 2024 into 2025. This move aims to stabilize the global oil markets amidst uncertainties surrounding the demand and supply dynamics. With us today is Nour Atkinson, the ex-head of oil market division at the International Energy Agency and an independent energy analyst. Nour, thank you so much for being here with us today. My first question is on OPEC's decision. I think it comes to no surprise. A lot of analysts already anticipated that the cuts would extend until the end of this year. How do you think this would impact the market prices for oil?
Well, the initial reaction to the meeting that took place yesterday is that prices, I think, early on Monday are slightly down, which I don't think is a big surprise. But I think the main message here is that the OPEC Plus alliance, through this very complicated combination of official cuts and voluntary cuts, is keeping in place a production management system, which, despite its complexity, is essentially fairly effective in managing supply and keeping the market as close to balance as the OPEC Plus countries would like. And, as you said in your introduction, it's not unexpected, but now we have a clear path through the rest of 2024 and some indications into 2025 of the thinking of the OPEC Plus alliance. And I think that's probably very helpful to the market.
We've seen that some of the countries have not been really compliant with the cuts, and some have been pushing for more production capacity. How do you think that would be resolved in the short term?
Well, as far as the overproduction is concerned, there are certain countries, including Kazakhstan, which and Iraq and the UAE, which, according to independent analysts, have been producing in excess of their quotas. But there are plans that have been agreed with the OPEC Secretariat that overproduction will be adjusted for in the forthcoming months. So in other words, they will produce a bit less so that over time the average production is in line with the quotas. Now, we'll wait and see if that actually does happen. The independent estimates, including my own, are that somewhere between 600,000 to 800,000 barrels a day is being produced in excess of the formal agreements made by the OPEC Plus ministers. But as I said, there is an adjustment process. So we'll watch out for that. The second part of this relates to countries which have been arguing for some time for a higher base from which their production quotas will be calculated. And two countries in particular here, we have Iraq and we have the UAE. Now, in the case of Iraq, their production capacity has been creeping up over months and indeed the last few years. And there will have to be some kind of adjustment to take care of them. However, the most important adjustment, an adjustment that's already been made, and another adjustment from the beginning of next year, is in the case of the UAE. Now, the United Arab Emirates, particularly, we're talking here about ADNOC in Abu Dhabi, has been expanding its capacity all the way along the value chain, all the way from exploration and production, all the way through refining and marketing, and indeed they are now quite active in trading. So the ADNOC company is becoming a much bigger player in global oil markets, and that this reality needs to be recognized by the OPEC Plus alliance. Their production capacity is heading up towards 5 million barrels a day, which makes them, behind Saudi Arabia, would make them the biggest capacity holder, at least within the traditional OPEC group. So the UAE is a very important issue. They have invested tens of billions of dollars in expanding their capacity, and they're asking that the OPEC ministers and the wider OPEC Plus ministers recognize that reality and reward them with a higher base from which you can adjust the quotas. So I don't think there's, although this situation is yet another challenge to the cohesiveness of the OPEC Plus alliance, I don't think in reality the desire of the UAE to have a bigger base from which to address quotas is an existential threat to the organization. It's just a question of recognizing a reality and recognizing that reality gradually and in an agreed way.
The whole point of these cuts is basically to, stabilize the prices in the market, right? So do you expect anything? I mean, we've seen the geopolitical tensions not impacting the prices really in the market. Do you expect anything to happen between here till the end of the year that would really impact oil prices?
Well, as far as the geopolitical issues are concerned, I think it's now very difficult to argue that there is any significant geopolitical premium in the oil price. The Russia-Ukraine situation, which has been going on for over 2 years now, has essentially settled down into an almost First World War situation of very limited gains by one side and some gains by the other. The supply situation from Russia for oil and gas is essentially settled down, and we have fairly clear visibility that Russian oil exports in particular are being maintained at pretty high levels, particularly to China and India. So there is now very little geopolitical risk attached to that. The sanctions from the G7 countries are just not working significantly. As far as the Middle East is concerned, since October the 7th, of course, there have been terrible events going on in that region. But the reality for oil market analysts is that however dreadful the geopolitical situation is and how awful is the loss of life in the Middle East, that we look, because it's our job, at the realities of oil supply. And the reality is that other than some attacks in the Red Sea by the Houthi rebels, which have led to the redirection of oil as opposed to a cut in supply, the actual impact on physical flows in the market from the post-October the 7th events has been minimal. And I think we can now recognize that normal oil supply life, to all intents and purposes, goes on. So if there's no geopolitical risk currently, we can never rule it out, of course, but currently there isn't. That means that we refocus on the fundamentals of supply and demand. Now, as far as 2024 is concerned, oil demand seems to be growing pretty steadily. There's a very wide difference, of course, in the estimates of demand growth from institutions such as my former colleagues at the International Energy Agency, who see demand growing by about 1.2 million barrels a day year on year, and of course colleagues at the OPEC Secretariat in Vienna, who see demand growth significantly higher, more than 2 million barrels a day. There are some signs that the pace of growth in China might be a little weaker than we'd first thought. So perhaps the tendency will be for demand to grow eventually by a number closer to the IEA's lower outlook than it will be to the OPEC Secretariat's higher outlook. And my own personal view is that oil demand will grow this year by, give or take, 1.4 to 1.5 million barrels a day. Now, you might think that that's a fairly healthy outlook, and the OPEC Plus ministers would be fairly satisfied at that pace of demand growth. But of course, we now have to focus on our non-OPEC production competitors. And here we're talking about Brazil and Canada, the United States and Guyana, and to some extent Norway. And what we are seeing is continued growth in production from the non-OPEC producers, which is sufficiently high that it basically eats into most of the expected increase in demand. So that means there's fairly little wiggle room for the OPEC plus producers to add more oil in the second half of the year, although there is some scope because the demand growth in the second half of the year is greater than the non-OPEC supply growth, but there's not a great deal of scope. But I think what the agreement on Sunday has demonstrated is that the OPEC countries, or the the OPEC plus countries, are confident that there will be more scope towards the end of the year for them to add some barrels into the market. And, what their agreement on Sunday has demonstrated is that although there is a fairly clear path through the rest of 24 and through the whole of 25 for them to add more barrels to the market as they see fit, they have made it very, very clear that the market situation will be reviewed on a very regular basis. And if there is no scope for them to introduce more barrels into the market, they won't do so. It's as simple as that. So I think they've done us a service in providing a roadmap for the rest of this year and for 25. And now you just have to wait on events and wait on what happens in the real world of the oil market.
Again, how do you feel about the dynamic between the non-OPEC producers and the OPEC producers? You just mentioned that basically the non-OPEC are going to be eating up the demand.
Yeah, well, the thing about the non-OPEC producers is that in the case of Brazil and Canada and Guyana in particular, the production that's coming on stream results from long-term investment decisions that have been taken years ago, big-ticket investment projects which are coming on stream as we've always known they will. There's no great surprise that Brazil is producing more oil, or Canada or Guyana, because, these are investment plans we know very, very well. The United States, of course, is slightly different because the shale oil output is rather more flexible. But as far as shale is concerned, I think everybody is expecting there'll be continued growth in 24 through 2025, particularly if oil prices are successfully managed by the OPEC Plus group in this $80 a barrel plus range. So there should be plenty of growth from the United States as well. And essentially, there's nothing the OPEC Plus producers can do. The only thing they could do if they wanted to curb growth from the non-OPEC producers would be to repeat the exercise they tried about 10 years or so ago, the end of 2014, when OPEC decided to maintain its production levels, decided to fight for market share. They found that the non-OPEC producers at that time, led by the big growth in the United States, were far more resilient than they expected, and we saw oil prices collapse from just over $80 a barrel at the end of 2014 to $30 a barrel at the beginning of 2016. Now, they could try, and if you like, sweat the non-OPEC producers again, but I really think that is almost, you could almost completely rule that out, because that would inflict self-harm on the OPEC Plus producers, as well as any damage that they might inflict on the non-OPEC producers. And of course, as far as we understand it, the producers led by Saudi Arabia, they need oil prices to remain at least at today's levels. And of course, they would prefer if the prices were higher, because they have big investment projects to fund within their own countries as they seek to diversify away from total reliance on the petrochemical, on the petroleum industry. So the producers are in a tricky situation. They have to hope that demand growth remains fairly healthy, and they have to hope that the non-OPEC production increases that we're all expecting are certainly no higher than we currently think, and that will give them some headroom to introduce more barrels into the market at prices which remain reasonably acceptable. So, it's a tricky situation. And frankly, the idea that the OPEC Plus countries can dramatically increase production this year and into next year, I think it's just very, very unlikely, and they have to accept it.
Neil, thank you so much for your wonderful insights. It's always a pleasure to speak to you. A big thank you to everyone watching. See you soon with another Energy Connects discussion. And until then, goodbye.